Good afternoon, ladies and gentlemen. Thank you very much for taking time out of your busy schedules to join our webinar today, the second installment of the year as we go through what's going on in the economy, how we're positioning clients' portfolios, and, well, really what's actually driving the markets these days. Before we dive in, just a bit of housekeeping rules, just to make sure everyone's on the same page. Dunhill Financial is a registered investment advisor. Information presented is for education purposes only. Nothing presented here is intended as an offer or solicitation. Please be sure to consult with a qualified financial advisor and or tax professional for any investment strategies discussed herein. And with that out of the way, I think let's dive right on into our agenda. Now, it's been no surprise that inflation is pretty much the talk of the town, regardless of which mainstream media outlet you happen to listen to. It's inflation, inflation, inflation. So with that being said, actually, what's going on with inflation, Brian? Why don't you give us a bit of a rundown?
Well, we always have to have a reason to celebrate. And with the coming 4th of July, I think we can actually play into this theme of inflation, into the fact that Monday we have a day off from the market. So finally we have a day where we can actually predict what's going to happen. It's going to just stay flat, right? But inflation for the 4th of July, we joked about this a couple turkey days in a row of the pricing of turkeys and everything revolving around turkeys. And now, appropriately enough, we're going to talk about it when it comes down to the 4th of July and what's the best meal for the 4th of July, but a good hamburger, where we've talked about the Big Mac index a million times, the Economist indicator of purchasing power from country to country. And here, Cam's put together a nice graphic from Statista that basically breaks down what the growth of the cost of all the ingredients inside of a hamburger have increased year over year. So I hope you load up on those tomatoes, because that's going to be the cheapest part of your burger when it breaks down to inflation. All that joking aside, if we stop eating so much food and start drinking more whiskey, we won't have an inflation problem. Essentially, in an odd way, tomatoes and whiskey have not grown in price, but pretty much everything else has.
Well, I don't know about you, Brian, but I don't think a burger with just tomatoes with maybe a glass of whiskey isn't going to do a whole lot. But I mean, with inflation and prices going up where they are, that might very well be the case. Okay, so what's actually going on here with inflation? What's driving it? And, what should we be looking for?
Well, we have multiple factors, and inflation impacts every single sector of the economy in a different way. Now, essentially, when we start breaking it down, there's 4 things driving inflation, right? So the first thing, our central governments and the Federal Reserve went ahead and printed a lot of money during the pandemic, a sign of compassion to make sure people didn't end up starving, right? Now, when you print extra money, essentially that excess supply ends up driving up the price of everything else. Now, we're getting some results, some reprieve from that in some due course. Mm-hmm. So what's the Fed done over there to solve that issue?
Well, I guess they've gone pretty much into reverse, right? If 2020 and 2021, they were opening the spigots and helping ease some of those difficulties, I think, they're going in reverse at this point and trying to tighten some of those spigots there.
Absolutely. So we have essentially, what was it, $95 billion that's coming due every single month.
I believe so, yeah. $95 billion is the runoff for the balance sheet.
On an $8.7 trillion balance sheet. So if we kind of equate that out, we're about 7 years away from the entire Fed balance sheet being run off. Now, it doesn't mean that we have to run off the entire balance sheet to go ahead and slow down that growth and increase interest rates, which will slow things down. So we can actually put that in the transitory case, where it's no longer inflating, but it's deflating, right?
Okay.
So transitory, hopefully it doesn't cause what we called last time a taper tantrum, but instead is a slow mechanism to alleviate some of this. Now, the second issue, supply chains. Now, supply chains have been severely disrupted because of the pandemic. And how are they starting to look?
Well, supply chains coming into 2022 were, pretty much as chaotic as they can get. Whether shipping ports in LA and Shanghai being congested because there's just not enough workers. In the case of the US and in the case of China, the zero COVID policy leading, just not enough people to unload and load some of those ships there. You're starting to see a massive backlog in some of those, orders and freights across the globe. With that being said, I think the prices of freight shipping has gone up quite exponentially as well. And actually that's had an impact on, pretty much everything.
Yeah, and we're starting also to get some reprieve there.
We are.
Microchips are one of the biggest items that have been disrupted by the supply chains.
Right.
And what are we getting? We're getting a bunch of fobs that are coming up online down in Spain, over in Arizona, or is it New Mexico? Someplace down there. Somewhere in the States. Southwest US.
Right.
I'm pretty sure it's Arizona. We're getting a whole bunch of fobs, and what they're doing for the water recyclage is just amazing, and a desert,
right,
per se. Now it takes a good year and a half to build a fob, so the onshoring effect of basically building things closer to home is taking place. So even if those supply chains aren't completely fixed, some of these disruptions will be fixed. So we can mark that as transitory as well.
Mm-hmm. Okay, so that's 2 out of the 4. What are the other 2?
Now, essentially, the third item becomes the effect of the fact that we were forced to save a ton of money during the pandemic. We couldn't spend, we couldn't go on vacation, we couldn't go out of the house, couldn't go to the restaurants. I was just looking at a chart from JP Morgan that basically said that for a period of time, we were down 95% on plane travel. Obvious. So all of a sudden we get to these positives and we get to spend that money. $2 trillion of excess savings in the United States. How can we put that in perspective?
Well, 2 trillion, that's a big number to throw around. It used to be that we talked in the millions and billions, and now all of a sudden we're up in the trillions here. But like Brian was saying, the excess savings that we've got are in excess of 2 trillion at this point. But if we look at consumer spending on average, I think back in July of 2020, so this was just after the pandemic and the lockdown and all of the effects that had across the economy, I think it was down to 11 trillion was the rough ballpark. Consumer spending dipped to 11 trillion, and now, well, we're back up to let me get the exact numbers here, don't want to misquote myself. 13.8, yeah, there we go. So 13.9 trillion. Yeah, there we go. Okay. Gotta have the exact numbers there. That's what you get when you have an analyst on the call. But yeah, 13.9 trillion is where we are now when it comes to the consumer spending part. So really, that's like you said, just that 2 trillion excess there, and with consumption going along at the trajectory that it's anticipated, that gives us how long until we
so that excess savings will be spent in less than a year. And where that exact starting point is, well, that's a little bit of a throw in the dart at the dartboard. But again, we can say that again is transitory in effect. So the main aspect, which I was trying to get the actual last part of this slide to show, that is what's going on in Ukraine. The war in Ukraine. Russia invading Ukraine has disrupted oil prices significantly.
And gas is pretty much exponential.
Any of those energy costs have gone up significantly. Now, not up to the levels that Morgan Stanley or Goldman Sachs was predicting. I think they were 200 and 150 a barrel. So not in that disaster zone, but in a territory where essentially oil and gas actually goes into the price of just about everything else, which is why you're seeing everything else being disrupted, except for orange juice for some reason. So maybe we shouldn't be doing the last slide on whiskey. We should be doing it on vodka or gin and get yourself some orange juice. And then you have a good life of 30% down on orange juice.
Right.
But I don't know why that is.
Probably sent to California, I would imagine.
No. Florida's where orange juice.
Florida's where the orange, Florida's the orange county.
But essentially, the mix of it is with high energy costs, essentially everything else is going to follow suit. That is not so transitory, and it gets a little bit nerve-wracking on effects because it becomes this circular motion. Now, I know there's a lot of data on here. You're going to send these slides out to everybody, right?
Yep, everyone will get a copy of the slide decks as well, just after the webinar, and actually we'll have a dedicated Q&A session as well towards the end, which I forgot to mention in the housekeeping part. But yeah, so feel free to continue posting your questions there in the chat, but you'll also get a copy of the slides as well.
Now, the wording on these slides is not our own. It's got a little bit more of a pessimistic tone, but this is the fear when it comes to inflation. And I'm gonna oversimplify it without the energy price. Everybody understands what inflation is. Ballpark, we're in upper single digits in a few places, above that, and a few places well above that. Cam will get into that regionally in a little bit. But essentially, if we say that inflation has gone up by 10% and everybody commands a 10% raise, then everybody's spending power is the same, and therefore they continue spending that same way, removing the economic principle of supply and demand because everybody has the same demand as they did the year before. This is where all of a sudden supply side inflation can turn into demand side inflation. In other words, right now, there's not enough supplies coming out when it comes to a lot of these commodities to meet the needs of countries because of what's going on in Ukraine. Mm-hmm. If all of a sudden everybody has the same buying power as they did before because everybody raises their wages or something else, then all of a sudden that becomes demand side inflation, and that can reverberate circling around year after year. And then we're starting to talk about a potential emerging market type of calamity where you can have hyperinflation. This is the growing fear. The best way to actually deal with inflation is to have a little bit of hurt in society. If we have less wallet share, we buy less. Therefore, the demand decreases. Therefore, the price can come down in simple forms.
Right. Well, at the end of the day, we have to understand a lot of, as Brian was pointing out, a lot of that inflation is very much supply side driven now. What some of the central bankers across the globe, they can engineer certain outcomes, but at the end of the day, the Fed can't print bread, they can't print wheat. Sure, you can have demand destruction there, but everyone's got to put food on the table, and like you said, that leads to this vicious cycle here. And then, I don't have to go into too much detail, but if we look at just some of the emerging countries and emerging markets that you were pointing out, like Sri Lanka, much of Africa, etc. The food crisis there is pretty much dire. And speaking of emerging markets and other countries across the globe, inflation has pretty much been on everyone's lips, but it's not a global phenomena as many would actually like it to believe. Now, yes, inflation is pretty persistent across, well, as you can see there on the chart, many places, but inflation isn't, it's certainly much worse in, for example, Russia, parts of Southeast America, Southern Americas, but there's a few blues in there, Brian, which don't seem to be suffering all that much from inflation. Why is that?
So let's start with what the blues are. The blues are where inflation is less than 5%. Now, let's throw China out the window because, well, we don't know what their figures really mean. But they do have control of their commodity markets a little bit better than a lot of other supply chains, i.e. they're buying the Russian oil that we're right now not buying, and they're getting it at a discount, about a $20 a barrel discount.
Yeah, $20 a barrel was the last
so they get to control their inflation through controlling some of those different commodities, but let's throw that out the window. To me, the interesting places are Australia, the Scandinavian countries, some of the African countries, and South America. Now, in each of these zones, one of the key aspects is that they control the commodity market. So the commodity cycle is benefiting them, which then gets them to be able to control that inflation. Now, naturally, where we have extremely high inflation are some of the same types of zones that actually Turkey's been all over the news. Russia's had hyperinflation for obvious reasons. Supposedly, they can't even get the car parts so that they can actually produce their own cars, and then they can't import cars. So here's your fun fact. Do you know the only country in the world where a car is an appreciating asset?
Well, that's, I don't know, pray tell.
Cuba.
Cuba.
Yeah,
Huh.
because they can't actually make their own cars and they can't import new cars. So a car is an appreciating asset, right? Again, back to the supply and demand. It's the basics of economic principles.
Right.
Now, if there's essentially demand, but there's not enough supply, the price goes up.
Right.
Now, Russia might be falling into that territory, which is inflationary because the cost of what should be a depreciating asset is actually going up. They're not able to produce more. So we're seeing essentially a tale of different zones. Inflation is a global issue. We can't just say that it's the politics of, this politician in the UK or that politician in the US, or the other in Germany. What it comes down to is there's universal issues that have caused the inflation, but other countries that are not having inflation issues because they're more commodity rich. The US won't have the same problems as Europe, simply put, because they're energy independent. Europe is not. So we're going to have winners and losers in this entire battle, and we should be focusing on our currency risk to reflect on that.
That's an interesting aspect there, Brian. I'm going to throw a bit of a curveball in there. So naturally, we talked about a bit of the commodity-rich countries. Your Australia's, your Scandinavian countries, etc. But there's a little bit of blue there in Japan. What's going on there? I did say I was going to throw curveballs.
This is the thing we've talked about time after time after time. Aging demographics basically changes the utility of what people are utilizing. And Japan has not had an inflation problem. They've been trying to create an inflation issue for years, but they've been basically trying to hold their currency at this point in time, devaluing their currency. So it's playing into that aspect, but that's that grander scheme of the average Japanese person is 10 years older than anybody in a developed market. So it's harder to actually produce inflation. For the retirees at home, get out more. Do more. That will solve some of the growth issues.
Okay, so we've touched upon inflation, but what does this actually mean? What does this mean for the end consumer? What does this mean for investors? And what does this mean for the wider economy?
Well, we use this chart in one of our last newsletters, and it says so much, but there's so much on this chart. So we'll spend a little bit of time on here so that you can linger on it. Essentially, what we have is our y-axis is made up by the PE ratio. This is the price to earnings ratio. This is why we own a company, is that it produces earnings. So if you think of the analogy of a house that you rent out, a piece of real estate that you rent out, the earnings would be the rent, right? So price over earnings gives us a valuation that we can actually state, is this an appropriate price that we're receiving for stocks?
Right. So to simplify things very, very, very simplistically, it's if the numbers are higher, it means it's more expensive. And if the numbers are lower, we're getting relatively good value for what we're buying. Exactly.
So now we have some color-coded areas where basically we can look at all these purple pieces right there in the middle, right? That's the dot-com era. Now, we all know that valuations got ridiculous in the dot-com era. And if you've been listening enough, you get a lot of newspapers that are saying, hey, we're valued in those near territories. Well, as you can see, that is a lot higher price to earnings ratio, and we haven't even gotten to the x-axis just yet. But you see that it's well above the line of where we're at on that orange segment. Now, the x-axis is marking the 10-year Treasury yield. So this is if you let the US government borrow money, where would we be as far as how much rent you're getting for lending them that money? Now, essentially, as you can see, we've gone from starting the year at below 2%, closer to 1.5%, if I remember correctly, to well above 3% now.
Right, and almost flooding with the 3.2s, 3.5s at this point.
So now, relative to any of the older folks on the call, you'll remember double-digit numbers on interest rates. easy time to buy a bond and sit back and just collect the coupon. We've gone through 40 years exactly since 1982 where interest rates have been moving down from their highs. So all of a sudden, we're looking at that point where for 40 years, we've gotten less and less by just lending money, and therefore we needed more and more from our companies. Now it looks like interest rates are moving back up. As you can see, there's a correlation. There's that perfect line that it tells us, based on where interest rates are, what price to earnings ratios should be. And this actually makes sense because during low interest rate times, you should be able to print money as a company by buying something lower risk, or I'm sorry, borrowing cheaper and lending it longer, and you can basically produce money. Right. So you borrow money at the bank and you lend it to a little bit riskier company as a loan or whatever it might be, and you can go ahead and lever up. Printing money in certain ways. You can do it over currencies, you can do it in multiple ways, but that leverage gives the opportunity for a higher PE ratio. Now, all of a sudden, if you as an individual had a mortgage that was costing you 7 or 8%, and we were trying to earn 7 or 8% in the stock market, we'd tell you, hey, pay down the mortgage instead of sending the money to us to invest it to earn the same amount as what it's costing you to borrow that money.
Right.
That's been the contrast for all these years. We've been able to borrow money on the cheap. So all of a sudden, having a mortgage has been beneficial. The higher interest rates go, all of a sudden, the lower those PE multiples should be. And that's what that line shows us. So now the question, the $1 million question is, where is the 10-year yield going to end up? Because if it stays around 3%, as you can see, we're well below the line for PE ratios. And therefore, we should earn back a lot of that money.
Right. So essentially, it's saying the damage, which we're seeing somewhat in recent weeks and months, is almost excessive to where we are in reality, right? So it's a bit of a huge disconnect there. Then,
on the other side, if we go up to 4% on a 10-year yield, then we're pretty much appropriately priced. It's only if we get to 5% on a 10-year yield that we're overpriced. So when you have a lot of newspapers kicking out that we're going into recession, there's all these problems, it's not guaranteed we'll go into recession, but we could.
Right.
It doesn't matter so much if we go into recession, it matters what the valuations of the market are. The average company on the S&P 500 actually beat their earnings estimates by 3%. Beat the expectations.
Right.
So year over year, the companies are doing fine, right? The valuations are down because essentially that cost to borrow money has gone up, and it should. But the question is, what are those driving forces? Which goes back to the one main takeaway that we want everybody to have, which is inflation, inflation, inflation. The higher inflation stays, the higher the Fed has to increase interest rates to slow down the market, to slow down that demand. If they slow down that demand, right, then essentially that inflation automatically comes down because people are not able to afford to buy.
Right. And I mean, we've seen that relationship quite clearly, as Brian was pointing out, when interest rates were pretty low. I mean, for the last couple of decades, we've seen interest rates do nothing but go down. You were starting to see a lot of excesses in some of the periphery markets, which I'm sure you'll, provide your colorful commentary on. And we've also seen a lot of those excesses come back down now.
Absolutely. And some of those excessive markets, which we can just pick on some of them. It's finally time that we've been negative about cryptos for years.
Right.
We can basically say any risk-on factor is getting demolished because, first of all, the leverage is getting more expensive.
Right.
And cryptos were all built on leverage. And second of all, that easy money is gone. So essentially, we can see those types of things happen, which looks like the exact same parallel as the Great Depression, which the silly money that was chasing after vehicles that just don't work is disappearing. Now, the good news is it's not pulling down the rest of the market in significant ways, like it did in the Great Depression, because there's regulation around the segment that we're in, around stocks, bonds, and the such, so they're not over-levered. But markets overreact, they don't react, they overreact, and that's exactly what, to me, this shows us. We know that the stock market is undervalued compared to where we're at currently. And going forward, we just want to have that question, where will inflation go? If we follow that the next couple of weeks, the next couple of months, if inflation goes down, we'll see our accounts go up. If inflation goes up, then essentially the question is how far up we'll go.
Bonds. Now, I think we've been hammering home on about inflation, rising interest rates. Now, I think no discussion on inflation and rising interest rates won't be without including bonds. Now, what's going on in the fixed income market, and, well, why does it look the way it does?
Let's go back to the basics of a bond. The basics of a bond is that it works just like a teeter-totter or a seesaw or whatever you want to call it. One side goes up, one side goes down. If interest rates move up, the people that own the lower interest rate bonds end up having something that they prefer the higher interest rate bonds. So the only way they can sell it is to sell it for less. So yields go up, values go down. Right? We've had 40 years where bonds essentially every single year interest rates were going down, therefore the value of the bond portfolio was going up. Now, we've historically had an undervaluation of bonds in every single one of our portfolios, from conservative all the way to aggressive. And this first half of the year proved that that was the right move to be in, because essentially for that 1.5% yield on a 10-year bond, we experienced what, 10 or 11%?
Right, yeah, 10 or 11% drawdown. So almost to break it down, you're taking twice the amount of risk, if not more, just for, well, 1x the upside, potentially.
Absolutely. It's not a good risk to reward premium because it acted in unison. Now, essentially, if interest rates can stay down here, these low rates, well, we're getting a decent yield, but not a great yield. There's still a lot of excess risk to reward. So this is why we're continuing to stay with a higher proportion of equities, because they're undervalued, as we saw, compared to what's going on, versus still the higher risk bond side of the equation. What we will look at doing is, if we get up to that 4 or 5% region on the bond portfolios, laddering some pieces, because there'll be excess potential return to gain it back over the course of time, but we're not there just yet.
Right. I mean, the chart pretty much, paints a nice picture there of what we're trying to get across, which is, being a bond investor this year, it's been a huge outlier compared to every other point in history. So surely there must be some form of, reversion to the mean. Again, assuming inflation actually comes under control.
Keyword: inflation, inflation, inflation. You stole the lines of a real estate agent, but essentially it works. It really works. There's only one thing driving all these forces, and that's inflation.
Right. So I guess, onto the next shot, which is, are bonds still a good place to be? And if so, when should we be looking at it? I mean, you were pointing out earlier on, Brian, just a few minutes ago, that the last couple of decades with interest rates falling, bonds have been a pretty good diversifier. But what holds, I should say, what does the future hold for bonds over the next couple of years?
Well, there's an expression: you don't want to catch a falling knife, right? And right now, bonds still feel like the falling knife. There's definitely some attractive yields out there, but if inflation continues to increase, we still have more downside than the upward side offers. In other words, if we're getting 3.2% on a 10-year bond, but it offers more than 3.2% downside, or we typically say we want 2 times the upside for 1 time the downside, essentially, we're looking at only being able to have 1.6% downside for 3.2% upside.
Right.
That's still not a good enough risk reward metric to get us to even weight on those bonds. it's making us say they're starting to look better.
But they're just not there yet,
They're
is what
just
you're
not
saying.
there yet.
Just going to do a quick check for time. We've got 15 minutes till our next Q&A section. So I'm just going to throw another curveball here, question for you, Brian. I know keep the curveballs coming. But what about for our more conservative investors? If they're more concerned about income, what places are we looking at in the portfolio to make sure they're continuing to get that income, especially if they're, you know, towards the latter part of their retirement?
Absolutely. Whenever it comes down to it, it should be a mix of introducing high dividend stocks and real estate. And I know this was our strategy coming into these problems, and I know it will be coming out, because at the end of the day, we need something to actually give us a correlation to that inflation, and the bonds are not giving us that correlation. Once that risk of inflation starts to dissipate, that becomes the time to start jumping in. Again, back to that analogy of the falling knife. You drop it in the kitchen, you try to catch it midair. You might catch the handle, but you also might catch the blade. You wait for it to hit the floor, you wash it off, now you're all good. You're only waiting a few more minutes, a few more seconds actually, hopefully.
Right.
Get a little matrix kind of effect there. So we really want to be cautious in that vantage point when it comes to the bond side of the portfolio, and we want to make sure that we're not trying to call bottoms on the market, because we could be there, but we might not be there.
Okay, so we've gone through what's going on, how is this potentially affecting the wider periphery, but why should I care? Why should investors care about inflation and the other items that are ongoing?
It affects us in every single way. If you're sitting on a lot of cash, right? All of a sudden, inflation is going to erode the value of that cash. The fun game to play with children is the rule of 72. You take whatever interest rate inflation is at, you take 72, divide it by that value, and that's the number of years it takes to have the value of that money. So for instance, if we have 8% inflation, that essentially means that every 9 years you would lose half the spending power of your money. Right? Now that's scary. Now, if it gets back down to the terms where we would assume they would be, I don't think we can get back to 2%. Like the Fed would like it to be, or the Bank of England would like it to be.
So you don't even think we'll get 2% in 2 or 3 years' time?
It's going to be a very, very hard job to get back down to those levels. And I hope I'm wrong. But essentially, being cautiously optimistic, let's go with a figure of 4%. That still means that it's going to take, or in every 18 years, we lose half the value of our cash. 18 years is a time period that we can all think of our planning. So we've gone from several decades of low inflation, a couple percent, sitting on cash in the bank. It's a small tax, but you know exactly what's going to be in there. Now sitting on cash, sitting on lots of cash, can actually be a huge tax and a huge weight on your wallet. From the other vantage point, while we're going to see some rocky rides when it comes to the bond market and the stock market, the bond market, well, okay, if we can get 3.2% and we have 4% inflation, okay, we're making up some of that potential inflation. But that's kind of like being the smartest monkey in the zoo. You know, you've got a title, but it doesn't really mean all that much. You've improved the situation. Or what's the other analogy? It's like laundry day and trying to pick out the least dirty shirt, right? It still stinks. We're making less than what the cost of goods are increasing. So the equity markets in the value segment that are paying good, decent dividends, that are able to pass on those costs to their customers, is still going to be the best place. Because even though you're going to get that price movement, if we have 5, 6, 7% inflation over the course of several more years, we're going to have some sort of correlation over the course of time.
Okay, so now we've touched inflation, we've touched supply chains, and I'm going to try to sort of tee this all into the topic that we're not trying to so subtly avoid, which is, well, Europe's got a big war right on its doorstep. So how would you anticipate, the Russian war in Ukraine affecting, well, the economy and maybe what we're seeing in the wider markets? Are we going to be seeing a risk-on appetite, a risk-off appetite? Are we going to, as you just glossed over the slides, are companies actually going to start thinking about where some of their bases and factories are actually based?
Absolutely, this will shift how economies are going to react and what we should be doing over the course of time, of which Cam has laid this out, where he's basically said there's 3 potential scenarios. One is that we get a quicker resolution to that war. Odds are next to nothing on that.
Right, and again, a resolution can probably take many different forms, right? Yeah.
But essentially, if we get a quick resolution, you're going to probably get a phone call from one of us basically saying, hey, we need to get everything that we can in as big of risk assets as possible to get the upside.
Right.
So we still have to have it in the playbook, but probably a 1 or 2% probability of it actually happening. The bigger opportunity there is that essentially this is going to be a longer, moderate war, of which there's going to be movements in and out and opportunities in and out, right? So this essentially will mean that the Fed will curb, they'll get to a number and they'll start to slow down. And that will give us an opportunity to start to increase our fixed income inside of our portfolios, to get back to a good mix of stocks and bonds, where bonds are not the riskiest part of our portfolio, but instead a decorrelator from the stock market. If we can get 4 or 5% on a 10-year bond, all of a sudden that becomes easy to generate a good income for someone if we can get inflation underneath those values. So that's the highest probability, is that this is going to be an ongoing geopolitical crisis. And essentially that will lead towards that 4 or 5% inflation, but also 4 or 5% interest rates. All I want are interest rates that are just a little bit higher than that inflation.
Right, but naturally, I guess in all of these scenarios, energy still plays a huge role. And I think, understating that is probably, a risk in itself. So how will that energy complex play out?
100%. And I think to answer that question, we should go back to that beautiful slide that you had on all the countries, the winners and the losers, when it comes to inflation. We will want to have a higher mix into regions where essentially they have energy independence, because they'll have more stability over the course of time. All right, so there's going to be winners and losers when it comes to currencies. There's going to be winners and losers when it comes to this aspect, and that's how we're going to weight our opportunities there the longer this drags on.
So would it be a fair assessment to say then some of the commodity-rich countries, maybe they'll finally have their time in the sun, after this huge, long decade of a strong dollar that we've seen?
100%. Minus Russia. We're not going to be buying Russia. Sorry.
I think it's pretty hard to get access to rubles anyhow, unless you're paying for gas. But that's a different story.
I think that was our last slide, if I remember correctly. Oh, no, I'm sorry. We've got one more, because we wanted to leave you on an optimistic note. I think we can all agree that essentially this is the point in time since we started the company where people are the most pessimistic. And it's odd that it took us sitting at home for 2 years where we weren't all that pessimistic to get to this point. But this chart really shows it. I think this is using the Michigan, the Michigan
Consumer Sentiment Survey.
Yep, Consumer Sentiment Survey by the University of Michigan. And basically all this is they call around to a whole bunch of people and they say, how do you feel about your personal wages? How do you feel about your expenditures? How do you feel about multiple things that affect your back pocket? And they gauge essentially what they should expect from consumers in the next year. And as you can see, we're closing in near where we were in August 2011, November 2008, October 1990. For the older ones on the webinar, back in May of 1980 and February of 1975. Lots of gray bars, those are our recessions, right? So essentially, consumer sentiment is at that point of us going into a recession, but we haven't gotten there just yet. Everybody's talking as if we are. We probably will. What is a recession really? 2 quarters in a row with actually shrinking GDP, i.e. that doesn't really impact the stock market in the same way that we would expect it to. So I'm not scared of the recession word, but what I'd like to point out to you is the returns in the year after each of those years. 1975, next year, 22.2%. 80, 19.2%. October 1990, 29.1. November of 2008, 22.2. August of 2011, 15.4. All of these are huge, huge gains in the next year, which contrasts to when consumer sentiment is very high. We've got 72 of negative 6.2%, 77, we've got only 1.2%, and going across the board for lots of low numbers compared to what's happening there. In other words, when everybody is being fearful, we need to be greedy. And when everybody else is being greedy, we need to be fearful. Right now, everybody's being fearful. And that's why we're looking at the stock market, the overall market, with optimism. We know that there's going to be a lot of bumps along the way. This is not going to be clean cut when it comes to energy prices, when it comes to fixed income and the likes. But there's many opportunities there. The company's earnings are growing. Our economies are actually still strong, and they're absorbing a lot of those problems that we had from the last 2 years. So we should be looking at this as the great opportunity for the next 3 to 5 years instead of as a calamity.
So almost you would say, this is not a perfect, but a pretty good contrarian indicator, and again, going back to some of the conversations I've had with clients, it's, hey, sometimes you have the best returns, quote unquote, in, when it's the darkest hour, essentially. But yeah, I think we're getting pretty close to time here now, so we'll probably start opening it up to Q&A if we haven't already had some questions there. But before we do, actually, we wanted to make a little introduction, Brian. So why don't you, as Brian's sorting through the questions, why don't we head on over to the next slide? Perfect. So we're always expanding the team, as always, and we've got a new member who some of you might have been in contact with, and you'll probably get to know him over the course of time. Martin Schroeder, here based in London, part of the London team. Martin's fluent in Czech and Slovak. Probably butchering the pronunciations here. He'll correct me later on offline. But yeah, he's a familiar face you'll probably be seeing over the next weeks and months. But on that note, actually, I think we want to leave it off on a little quote here from Antola. I think it's Antola, who is a French poet by all means. But Brian, do we have any questions there? Let's see.
We have several. It looks like Anya's already taken care of George and Barbara's question about BIPs. Let's see. If you don't have a 10-year time horizon and you are currently getting 0.5% on your bank CD, but are losing 6% or more on inflation on your savings, what is the smart investment now? When do you think banks will start raising their interest rates on savings and CDs? That's a wonderful question, Hugh. So the banks are always going to go much slower than the Fed because that's how they make their money. So when it comes to Europe, it's probably going to be some time before we actually see the restrictions coming off banks having a top end of what you can have without having to pay interest. On the US, we're starting to see a little bit of an increase in interest rates, but we're talking about basis points instead of full percentages. And it's always likely going to be that. I think the question comes into really how much should we be sitting on in cash in CDs versus in cash and CDs. In other words, it should only really be the rainy day funds that are inside of there. That being 6 months or so of expenses to make sure that we can weather a storm like we've dealt with so many in the last couple of years. Then shifting that other money into means, like I was saying, of higher dividend paying stocks slash real estate and the likes, where they can at least meet those inflation parameters over the course of time.
Right, and naturally that equation changes, if the banks start to actually, offer real rates of, 7, 8, 9, whatever percentage it is. But, as Brian was saying, they're pretty slow to the upside, and again, pretty slow to the downside as well, because, well, that's how they make their margin, by borrowing cheap and then lending it slightly more expensive, and vice versa. We've got another question here from Drew, which is regarding ESG policies. So have ESG policies negatively impacted investing in carbon energy or the dirty fossil fuels like oil and gas and subsequent R&D infrastructure in that side? Has that exacerbated some of those supply chain issues, leading to said higher prices? Oh gosh, this is a multifaceted question here. And then what are your thoughts on the future of oil prices, particularly in light of these ESG conscious investors and government policies constricting some of the flows towards that?
Oh, there's multiple lines that can be played with on there. Gosh, I got to look at it a little bit deeper. But here in the UK, we just introduced an excise tax on the profits of some of these energy companies.
We did.
And I tend to think that in a populist world, we might see a little bit more of that, which might be a hindrance on some of these companies. On vice versa, BP, British Petroleum, or what they went by for a little while, Beyond Petroleum, just overpaid significantly, in my mind, for what's going to be the biggest wind farm project in the world off the coast of Ireland. In other words, the lines are going to be blurred between ESG companies and some of what we would have agreed were the dirtiest companies out there. They're going to blur those lines on purpose, so that essentially you have to make the decision of whether you're buying up or basically you're restricting out from those vantage points. So essentially, when you're investing in these types of areas, it becomes a little bit harder to define exactly what you're buying. What is it? 19 out of the top 20 ESG ETFs actually have ExxonMobil in them, right? Now, I forget the guy in the Financial Times, but he makes an interesting argument for ESG, that essentially by owning a company and having the voting power, it does more for ESG values than just not investing in a company at all. In other words, keep your enemies close and your friends close and your enemies closer, right? ExxonMobil last year was forced to introduce 2 new board members onto their board of directors. And this is a company that is ExxonMobil. It's
right.
One of the dirtiest companies out there.
Right.
Again, the blurring of the lines, and it becomes what is the activity when it comes to that ESG provider. What are we really gaining in value? And that is where we're really trying to define what we're trying to do with ESG. It's not only what do we want to see inclusive in our portfolio, but also how are we voting? How are we implementing the change that we would like to see? So we're seeing it on every side, because at the beginning of the year, I know in one of our ESG funds, we dodged a bullet that when energy prices went up, and therefore we lost a little bit of opportunity by not having as much energy in there as the S&P 500 would have, because Facebook is not deemed to be socially responsible for pretty obvious reasons. When Facebook crumbled, we avoided those losses. Got a little lucky on that one, I would say.
Right.
But there will be a decorrelation from those aspects. We had a decade with energy prices going down. Now we have high energy prices. So the question becomes, will the governments try to retract some of that, or will it pass through? You know, this new government tax in the US that Biden put in place for 3 months. Well, it's the energy companies that collect the tax. So they might not even pass it on to the consumer. So it might just be a huge cost to the government with no reprieve from the consumers. and they wouldn't break any of the overall rules. These are all those aspects that energy prices are really going to be driven by supply and demand, just going back onto that simplicity. And the more we see these tax cuts, the more we see essentially one-off taxes on the other side, the less of a hurt on that demand is going to be placed.
Right.
And therefore, the slower it's going to come back down into size.
I'm going to tackle the other part of Drew's question, which is where do you see oil prices? Now, neither one of us like to make any forecasts, but I'll do the honors and stick my head out there. But again, this isn't this is what we're predicting, but typically in the past, whether you look at 2008 or the early 2000s, every time oil has got to the $150 region, you've always had demand destruction, because when oil is at $150 a barrel, we have to understand the supply dynamics, right? Because the Middle East, they're making money head over fist, but all of a sudden you have supply coming online from US shale, because all of a sudden it's very profitable for them to continue fracking and pumping oil out of the sands and the ground there. On top of that, naturally, you have the whole OPEC plus trying to sort of vie for dominance, and it just becomes too enticing to not flood the market with excess supply. Now, naturally, at $150 a barrel on oil, people are going to be traveling less. They're going to be filling up their cars less potentially, and all of a sudden that might also translate into less flights, so therefore less demand on jet fuel and everything else. So where oil prices really go in the short to medium term, that's completely predicated on, well, where the war in Russia and Ukraine goes and how the energy dynamics play out. If Russia cuts off oil and gas to Europe tomorrow, I'd say it probably have a huge impact on the oil market. But if it continues to eke out as it has, oil will probably drift lower. Again, that's just my personal opinion here. What are your thoughts there, Brian, on the
absolutely.
oil dynamic?
I think you can play into what the long-term themes of these things are. When you look at essentially renewable energy, China has been at the forefront of this. In certain regions of in Europe have been really pushing towards this. It's more about getting energy independence, and they've been working towards that for past years, and they will be working at it even harder now than they were before. This will become the continued trend, and there's a large Danish wind farm, and the CEO came out and he said, in the past, it took us 4 years of bureaucracy to get a wind farm built and 1 year to actually build it. And we're hoping with all of this turmoil that we can get that bureaucracy down to 3 years. But that still means it takes 4 years to get a wind farm up and running, right? Which really tells us what our biggest problem is of getting to a renewable system and essentially have a system in which we're energy independent from the likes of Russia or any of these other oil producers, which is actually getting out of our own way and building the means of storage, of energy production and the likes.
Hopefully that answers your question there, Drew. Otherwise, feel free to follow up. We've got another question from Sarah. Can you explain the US Treasury bonds offered now at 9.62%? How can they offer that rate? I think Sarah here is referring to the I series of bonds. And why don't you give us the lowdown on that, Brian?
So in all simplicity, they basically pay an interest rate plus inflation. Each person is allowed to buy $10,000 from the window. Otherwise, you're buying the excess on the secondary market instead of directly from the government. Now, what we have to remember is inflation is actually quoted as a percentage. So if we buy these on the secondary market, so if we go buy $100,000 worth of these I bonds through an ETF or anything else, if inflation goes down from that current rate, all of a sudden we could actually have losses on our treasury bonds.
Yeah, I think the negative convexity there works on both sides.
Exactly. So if all we're doing is hedging that inflation and buying $10,000 from the window becomes attractive, that might be an element to do. But essentially, it's not something that we can use as an ultimate hedge there, because we end up having just as much risk as we have reward on a year-to-year basis.
Got it. So there's your answer there, Sarah. Hopefully that helps. So again, if you can buy out the window, 10K is your limit. If you want to buy on the open market, probably take a second take on that. Right, let's see any other questions. Again, feel free to post them in either the chat or the Q&A function. We're sifting through both here.
So here's a statistic from JP Morgan that I really liked. Essentially, if we look back from 2019, essentially seated dinners went down 100%. Basically, all restaurants were closed down, right? Now, right now, we're only -3% from what we were at pre-pandemic, right? Hotel occupancy is only down 6% from where we were at pre-pandemic. TSA travel down 11%. So we've nearly fully recovered to those same levels that we were pre-pandemic to now. Maybe if we don't have a few train strikes or airline strikes calling out on British Airways, Lufthansa, Brussels Airlines, all going on strike right as we're trying to get back, we could get to full recovery in the leisure sector, which is, to me, extremely exciting, because with all this negativity, what are we really seeing? The overall economy has recovered and it's back.
That's an interesting little statistic there. I mean, coming into 2020, many people thought this would be the year of normalization. This would be the year we think returns back to normal. We can get out there and get on with our lives. But naturally, as with black swans, I think, as you mentioned in your last seminar there in France, nobody said there'd be multiple black swans in quick succession.
Yeah, absolutely. The other thing that I think is fun to look at, which is problematic from an inflation vantage point, but really great news. Unemployment is at its lowest level since 1953.
That's a pretty optimistic statistic right there.
Exactly. Now, what does high employment mean? People have excess money, which is a driver of inflation. So some of the reasons that we're getting inflation are actually good news overall, but essentially higher interest rates should mean a little bit higher unemployment, which is why it's going to feel counterintuitive when you see bad news on the front page of the newspaper. You're probably going to see the stock market increase. Last week we had the payrolls number come out, just a little bit off of what expectations were, and all of a sudden the markets soared. Feels counterintuitive. The economy is doing worse, so therefore the stock market does better. But the reason why is because it means the Fed will not have to behave so much. So it just goes right back to that inflation.
I mean, we've seen that, over the last couple of days where, major companies, whether it's Tesla or some of the newer fintechs, announcing layoffs and such just to manage those costs. And, really just going back onto the whole jobs number there. Essentially, we're probably going to have to see some unemployment there to really hone in on that inflation part, because, as you were saying, Brian, bad news becomes good news, because it means then the central bankers don't have to be as aggressive in their combat of inflation. So, yeah, little counterintuitive, but that just happens to be the marketplace that we're in, where good news is bad news, but bad news happens to be good news for the stock market, at least, because it's a forward-looking mechanism.
Absolutely. On that note, I think we're out of time at this point in time. You'll be sending out the recording to everyone and the slides. As always, if you have any questions, big or small, if you agree with us, disagree with us, we'd love to hear your thoughts. Drop us an email, give us a call. Love to hear from you. Hopefully the second half of this year will be a little bit easier and a little bit better on our wallets than the first half of the year. But regardless, we'd love to talk to you. Stay safe. Have a great summer. Talk soon.
Perfect. Thanks very much. Take care.